Picture a Tuesday morning in 2026 when every phone in America buzzes at the same moment with a headline that feels impossible to read twice. The dollar has just posted its steepest weekly slide against a basket of world currencies since the 1980s, and for the first time in modern history, gold sitting in central bank vaults around the world is worth more than the U.S. Treasury bonds those same banks are holding. It sounds like the opening scene of a disaster movie, but this is not fiction. This is the slow-motion story already unfolding beneath the surface of the world's largest economy, and to understand it, you have to meet someone who is living through it without even realizing it yet. Meet Sarah, a 42-year-old hardware store owner in Columbus, Ohio, who inherited the shop from her father and has spent the last 15 years building it into the kind of place where contractors, weekend homeowners, and retirees all know her by name. Sarah has never cared much about foreign exchange reserves or reserve currency status. She cares about restocking shelves, paying her 4 employees, and keeping the lights on. But the truth is that the biggest financial story of her lifetime is happening in the background of every single one of those decisions, whether she notices it or not. For 80 years, the U.S. dollar has been the undisputed king of global finance. The currency oil is priced in, the currency central banks stockpile to protect their economies, the currency that lets the United States borrow more cheaply than any other nation on earth and run deficits that would sink almost any other country. That privilege did not happen by accident. It was built after World War II when the dollar was pegged to gold and the rest of the world agreed to hold dollars as their reserve of choice. And even after that peg was broken in 1971, the dollar's dominance never really faded, it just evolved, propped up by the size of the American economy, the depth of U.S. financial markets, and the simple fact that there was no real alternative. But 2026 is different, and the cracks that analysts have been quietly pointing to for years are now impossible to ignore. The dollar's share of global foreign exchange reserves has slipped to roughly 58%, down from more than 70% at the turn of the millennium, and while that decline has been gradual, the direction has been consistent for 2 decades straight. Central banks are not abandoning the dollar overnight, but they are quietly diversifying, and the asset they are choosing most aggressively is gold. In 2026 alone, central banks are expected to buy more than 800 tons of gold, continuing a buying spree that has pushed gold's share of global reserves higher than U.S. Treasury holdings for the first time since 1996, a milestone that would have sounded absurd just a few years ago. Gold itself has been on a historic run, smashing through $5,000 an ounce in January of 2026, and touching an intraday high above $5,500, with major banks like Goldman Sachs and Wells Fargo now projecting prices climbing toward $5,400, $6,000, and in some bullish scenarios well beyond that by the end of the year. When the most conservative institutions on the planet, the ones that manage entire nations' wealth, start buying gold at this pace, it sends an unmistakable signal that trust in the old system is being hedged, quietly but deliberately. At the same time, a new financial architecture is being built specifically to bypass the dollar. In late 2025, a bloc of 10 nations, including Brazil, Russia, India, China, and several others, launched a pilot for something called the unit, a digital settlement currency backed 40% by physical gold and 60% by a basket of member currencies, designed to let countries trade with each other without ever touching a US dollar or routing a transaction through the Western banking system. It started small, just a pilot with a handful of units issued, but the direction of travel matters more than the current scale, because trade between China and Russia is now settled almost entirely in rubles and yuan, cutting the dollar out of one of the largest bilateral trade relationships on Earth. And payment systems built by China are increasingly processing transactions that once would have run through SWIFT and New York clearinghouses. None of this means the dollar collapses tomorrow. The euro lacks the deep, unified bond market needed to truly replace it. And the yuan is still held back by capital controls that keep it from becoming a fully global currency. But the erosion is real, it is measurable, and it is accelerating in ways that would have seemed like fringe speculation only a decade ago. Meanwhile, back home, the foundation supporting the dollar's privileged status is under its own kind of pressure. The national debt crossed $39 trillion in 2026, a number so large it barely means anything until you break it down. Roughly $114,000 for every single American, more than $285,000 for the average household. The government is now borrowing more than $150 billion every single month just to keep operating, and the interest alone on all that debt has surged past $1 trillion a year, making interest payments one of the fastest growing expenses in the entire federal budget. To put that in perspective, interest on the debt is projected to overtake spending on Medicare within the next 2 years. And by the late 2040s, it is expected to become the single largest expense the federal government has, larger than defense, larger than every discretionary program combined, which means the country will soon be spending more just to service the debts of the past than to invest in the future. Economists at the Penn Wharton budget model have warned that once debt crosses roughly 210% of GDP, there may be no realistic tax increase capable of covering the interest payments without triggering a default on either government bonds or programs like Social Security. And while the threshold is still decades away on the current path, the trajectory itself is what keeps investors nervous, because trajectories are exactly the kind of thing markets price in years before they actually arrive. Back in Columbus, Sarah does not read Treasury reports or Federal Reserve minutes, but she feels every one of these forces land on her shop in very physical ways. Her supplier invoices for imported tools and hardware have climbed steadily for 18 months straight, a direct result of tariffs that have pushed input costs higher across nearly every category of goods that touch a global supply chain. Nationwide, 78% of small business owners say tariffs have raised their operating costs in just the past 6 months, and 3 out of 4 say managing cash flow has become their single biggest daily challenge, a level of financial stress that used to be reserved for full-blown recessions, not a supposedly steady economy. Sarah has done the math on her own margins more times than she can count, and each time the answer is the same. Either she raises prices and risks losing loyal customers who are already stretched thin themselves, or she absorbs the cost and watches her already thin profit margin shrink even further. She is not alone. Confidence among small business owners in their ability to absorb further cost increases sits at just over 2 out of 5 nationally, which tells you everything about how fragile the foundation under Main Street America has become, even while headline economic numbers look relatively calm on the surface. Borrowing has not gotten any easier either, because when the federal government has to offer higher interest rates to convince investors to keep buying its debt, those higher rates ripple outward into every corner of the private economy, raising the cost of a business loan, a mortgage, a car payment, an equipment lease, everything Sarah might need to grow or even just to keep her doors open through a slow season. She has started sourcing more of her inventory from smaller domestic suppliers instead of overseas manufacturers, not because it is cheaper, in the short term it usually is not, but because the uncertainty of relying on volatile international shipping costs and shifting tariff policy has become its own kind of risk that she can no longer plan around. Zoom out from Sarah's shop, and you see the same pattern playing out at a national scale. Retirement accounts have swung through periods of sharp volatility as investors try to price in a world where the old assumptions about American economic supremacy no longer feel guaranteed. Companies have grown more cautious about hiring, adopting what economists are now calling a low fire posture, meaning businesses are not laying off workers in mass numbers, but they are also not adding new positions, leaving the labor market in an uneasy holding pattern that makes career security feel less certain than it has in years. And while all of this happens inside the United States, the rest of the world is not standing still. China's economy, even while dealing with a prolonged property market downturn and a slowing population, is still expected to grow somewhere between 4 and 5% in 2026, comfortably outpacing America's roughly 2% growth rate. And while the U.S. still holds a commanding lead in nominal GDP at nearly $29 trillion compared to China's roughly $18 trillion, that gap tells only part of the story. When you measure economic output by purchasing power rather than currency exchange rates, China has already been the larger economy since around 2014, and it continues to widen that lead every single year. India, Indonesia, and a wave of other fast-growing economies are climbing the global GDP rankings as well, meaning the conversation is no longer just about whether America stays number one. It is about how many seats are now at the table that used to belong exclusively to Washington. This is the part of the story that most headlines get wrong, because losing a title is not the same thing as losing everything. Throughout history, the world's dominant reserve currency has changed hands more than once. The Dutch guilder gave way to the British pound, and the British pound eventually gave way to the American dollar after 2 world wars reshaped the global order. And in both of those transitions, the country losing its top spot did not vanish. It adapted, sometimes painfully, sometimes over decades, but it adapted. That is the piece of the story Sarah is living out in real time without ever framing it in those terms. Faced with rising costs and tighter margins, she did not close her doors. She got creative. She invested in a point-of-sale system with basic inventory forecasting. So she stops over-ordering products that sit on shelves collecting dust. She built out an online storefront so contractors across the state can order specialty parts without waiting for a delivery truck. And she leaned harder into the kind of personal expert advice that big-box retailers and algorithm-driven marketplaces simply cannot replicate. Because a customer who wants to know exactly which drill bit will work for a specific old farmhouse door hinge still wants to talk to a person who actually knows the answer. That instinct, adapt or get left behind, is playing out at a national scale too, and it is arguably America's strongest remaining card. The same tariffs and rising costs that are squeezing small businesses are, paradoxically, accelerating a wave of manufacturing reshoring. as companies that spent decades chasing the cheapest overseas labor now find that automation, robotics, and artificial intelligence make it economically viable to build things closer to home again. At trade shows and manufacturing conferences throughout 2026, the dominant theme has been the convergence of AI-driven automation with onshoring pressure. Factories that once required hundreds of workers performing repetitive tasks are being redesigned around flexible, software-driven systems that can be retrained for a new product line in days instead of months. And nearly a quarter of manufacturers now say they plan to deploy physical AI systems, everything from autonomous mobile robots to AI-assisted quality inspection, within the next 2 years. This is not a return to the manufacturing economy of the 1960s. It is something new, leaner, more capital intensive, and less dependent on cheap labor as the deciding factor in where a factory gets built, which means the calculus that once pushed production to the other side of the world no longer holds the same weight it used to. Tax incentives for domestic equipment investment, renewed trade agreements that reduce some of the uncertainty businesses have been wrestling with, and an enormous wave of capital flowing into AI infrastructure and semiconductor production are all converging at once. And while nearly 500,000 manufacturing jobs currently sit unfilled because the skills required have shifted so dramatically toward robotics and digital systems, the companies leading this transition are treating workforce development not as a cost center, but as a competitive strategy, partnering with community colleges and vocational programs to build a pipeline of talent that simply did not exist a decade ago. It helps to understand how the last transition like this actually unfolded, because it did not happen the way most people imagine. When the British pound lost its status as the world's dominant reserve currency to the American dollar, the process took roughly 3 decades from the first serious cracks appearing to the final handover being complete. Stretching from the financial strain of World War I through the aftermath of World War II, and for most of that period, ordinary people in Britain had no idea a handover was even happening. They simply noticed that imported goods cost more, that government bonds paid less relative to inflation, and that London's bankers seemed increasingly nervous about decisions being made in Washington rather than decisions being made in their own boardrooms. The pound did not vanish. Britain did not stop being a wealthy, powerful nation. It simply stopped being the automatic default choice for global trade and reserves. And the British economy spent the following decades rebuilding its identity around different strengths: financial services, pharmaceuticals, higher education, and a residual but still meaningful role in global finance through the City of London. That history matters here because it suggests the current period, if it does eventually mark a real inflection point for the dollar, will not announce itself with a single dramatic collapse. It will instead be lived exactly the way Sarah is living it, as a slow accumulation of slightly higher costs, slightly tighter margins, and slightly harder decisions that only look like a historic turning point when you zoom out far enough to see the whole pattern at once. There is another layer to this story that rarely makes it into the headlines, and it involves the plumbing of the global financial system itself, the unglamorous infrastructure that actually moves money between nations. For decades, almost every major international transaction eventually touched the SWIFT messaging network and cleared through correspondent banks in New York, giving Washington enormous leverage, because control over that plumbing meant the ability to freeze a hostile nation's assets or cut an entire country off from the global financial system with a single decision. That leverage was used aggressively against Russia after 2022, and the lesson every other government watching quietly absorbed was simple. If you keep the bulk of your reserves in dollars and route your trade through dollar clearing systems, your economy is vulnerable to a decision made in Washington that you have no vote in. That single realization, more than any ideological objection to American power, is what has quietly pushed central banks from Beijing to Riyadh to New Delhi to start building parallel infrastructure. Project M Bridge, a collaboration between the central banks of China, Thailand, the United Arab Emirates, and Hong Kong, with Saudi Arabia joining more recently, is testing a cross-border digital currency platform specifically designed to let participating nations settle trade without ever touching the dollar clearing system. And while it remains a pilot program today, so did almost every piece of financial infrastructure that eventually became indispensable. China's own cross-border payment system, built as an alternative messaging network to SWIFT, processed the equivalent of roughly $24 trillion in transactions in a single recent year, still a fraction of SWIFT's total volume, but growing at a pace that has caught the attention of every major central bank on Earth. None of these systems need to fully replace the dollar to matter. They only need to give countries a credible alternative during moments of political tension, and the mere existence of that alternative changes the negotiating leverage America has held almost unchallenged since the end of World War II. Meanwhile, back in Washington, the debate over how to manage the debt has become one of the most consequential and least understood fights in the country, because the choices are genuinely brutal. Either cut spending on popular programs that tens of millions of Americans rely on, raise taxes in ways that slow economic growth, or keep borrowing and hope that growth eventually outpaces the debt, a bet that is not paid off for over 2 decades running. The Federal Reserve finds itself caught in the middle of this because every interest rate decision now carries an extra layer of political weight. Cut rates too aggressively and risk reigniting inflation that erodes the purchasing power of every paycheck in America. Hold rates too high for too long and risk making the government's own interest payments even more unsustainable. A scenario some economists have started calling fiscal dominance, where debt levels become so large that monetary policy is effectively held hostage to the government's own borrowing needs, rather than being free to focus purely on inflation and employment. That tension explains why markets have grown so much more volatile every time a Fed meeting or a Treasury auction produces even a slightly disappointing result. Because investors are no longer just pricing in next quarter's growth number. They are pricing in the long-term credibility of the entire system. Back on Main Street, this shows up in ways that rarely get connected to the bigger picture. Sarah's landlord raised her lease renewal rate last year, citing higher borrowing costs on the building's mortgage, a direct traceable line from a Treasury auction in Washington to a rent increase in Columbus that most people would never think to connect. Her employees have noticed their grocery bills climbing faster than their paychecks, and 2 of them have picked up second jobs just to keep pace. A quiet erosion of purchasing power that shows up in consumer sentiment surveys long before it shows up in official inflation statistics. And yet, even inside all of that pressure, there are genuine signs of resilience worth taking seriously. American consumer spending, while more cautious than it was a few years ago, has not collapsed. Households have adjusted their habits, trading down on discretionary purchases while still protecting spending on necessities, a sign of a population absorbing a shock rather than being overwhelmed by one. Corporate earnings among companies that have successfully reshored parts of their supply chain or invested early in automation have in many cases outperformed their peers who stayed fully dependent on overseas manufacturing, suggesting that the businesses treating this moment as a forcing function for modernization are already pulling ahead of those simply hoping conditions revert back to how they used to be. Universities across the country, despite funding pressures and political battles over research budgets, continue to file more patents and produce more startup founders than any other higher education system on the planet. And venture capital, even in a more cautious environment, continues to flow disproportionately into American artificial intelligence, biotechnology, and advanced manufacturing companies compared to anywhere else in the world, which matters enormously because the next era of global economic leadership is far more likely to be decided by who controls the most advanced technology than by who holds the most reserve currency status. None of this erases the very real challenges sitting on the other side of the ledger. A national debt climbing past $39 trillion does not resolve itself through optimism alone. A currency losing reserve share year after year does not automatically stabilize just because the decline has been gradual so far. And a rival economic bloc actively building payment infrastructure designed to route around the dollar is not something policymakers can afford to dismiss as fringe theorizing anymore. The honest picture sitting underneath all of this is more complicated than either the doom headlines or the reflexive dismissals suggest, because the dollar remaining dominant and the dollar's dominance being seriously challenged are not mutually exclusive statements. Both can be true, and both currently are. What history actually shows, again and again, is that the nations which weather a shift in global economic standing are the ones that keep investing in the things that made them powerful in the first place. Education systems that keep producing engineers and researchers, a culture that still rewards entrepreneurs willing to take a risk and open a shop or launch a company, capital markets deep and liquid enough that the rest of the world still wants to park its money there, even when it is diversifying elsewhere, and a legal and political system stable enough that contracts get honored and property rights get respected. America still holds enormous advantages on every one of those fronts, the deepest and most liquid capital markets on the planet, a research and university system that continues to attract the best talent from every corner of the globe, and a technology sector, particularly in artificial intelligence, that remains years ahead of most competitors, even as China closes the gap in specific sectors like electric vehicles, batteries, and advanced manufacturing. The real question was never whether the United States would remain permanently, unquestionably, number one forever. Because no nation in recorded history has held that position indefinitely, the real question is whether the country adapts fast enough to a world where it has powerful competitors, instead of a world where it has none. Sarah's hardware store is a small, almost invisible data point in that much larger story, but it is also a preview of exactly how this transition plays out for millions of ordinary people. Not through a single dramatic headline moment where everything changes overnight, but through 1,000 small daily decisions. A supplier switched, a price adjusted, a new sales channel opened, a family budget recalculated at the kitchen table, repeated across millions of households and businesses until, 1 year later, the economy looks different without anyone being able to point to the exact day it happened. If gold keeps climbing toward the $6,000 level that some banks are now forecasting, if central banks keep shifting reserves away from treasuries, if the BRICS settlement currency keeps expanding beyond its current pilot phase, and if America's debt keeps compounding at its current pace, the pressure on the dollar's dominant position will keep building, slowly, unevenly, but persistently. That does not guarantee collapse, and it does not guarantee a smooth landing either. It guarantees exactly what history has always guaranteed during these transitions: a period of adjustment that rewards adaptability and punishes complacency. The businesses and households that treat this moment as a wake-up call, diversifying supply chains, investing in efficiency, building financial cushions, and staying genuinely informed instead of reactive, are the ones most likely to come out the other side stronger, the same way Sarah's shop, after 18 months of tighter margins and harder decisions, is now more resilient, more efficient, and arguably better positioned for the next decade than it was before any of this pressure started. There is one more thread worth pulling on before this story reaches its conclusion, and it involves the stock market itself, the single most visible barometer most Americans use to judge whether the economy is healthy or struggling. Even as debt figures climb and reserve currency questions swirl in the background, American equity markets have continued attracting enormous global capital, partly because, despite every structural concern, U.S., companies still dominate the industries. Investors care most about right now: artificial intelligence infrastructure, cloud computing, semiconductor design, and biotechnology. Sectors where American firms hold a lead that rivals have not yet closed and, in some cases, are not close to closing. That paradox, a currency losing ground while the equity market built on that same currency keeps attracting global money, is exactly the kind of contradiction that makes this moment so difficult to summarize in a single headline. Because the story is not simply decline, it is a bifurcated economy where some sectors are pulling dramatically ahead while others, especially the small, labor-intensive businesses like Sarah's hardware store, absorb the costs of transition without capturing much of the upside. That divide matters enormously for how this era gets remembered. Because if policymakers focus only on the strength of the stock market and the technology sector, they risk missing the slow erosion happening underneath it in communities that do not have exposure to AI stocks or venture capital returns. The towns and neighborhoods where a 10% increase in the price of steel or lumber or imported electronics is not an abstract statistic, but a direct hit to a family's monthly budget. Sarah has started thinking about her business less as a static shop and more as something she has to actively steer, checking commodity price trends the way she used to check the weather forecast, building relationships with 2 or 3 backup suppliers instead of relying on a single overseas source, and setting aside a small cash reserve every month specifically to absorb the kind of cost shock that used to blindside her without warning. She has also started talking to her employees more openly about the pressures the business is facing, not to alarm them, but because she has learned that a team that understands why prices are moving and why decisions are being made tends to stay more loyal and adapt more quickly than a team kept in the dark. It is a small, almost mundane form of resilience, nothing like the dramatic headlines about gold prices or BRICS currencies, but it is exactly the kind of resilience that adds up, business by business, household by household, into whatever the American economy actually becomes on the other side of this transition. The lesson underneath the headlines, the debt figures, the gold prices, and the currency charts is ultimately a strikingly human one. Economic dominance was never really about holding a permanent title. It was always about the ability to keep building, keep innovating, and keep adapting when the ground shifts beneath you. And that is a test the United States has faced before, weathered before, and is being asked to face again right now, not as a single catastrophic event arriving on a Tuesday morning headline, but as a slow, grinding, very real transition that is already well underway, one hardware store, one small business, one household budget at a time. And how this story ends will be decided not by any single policy or headline, but by whether the country and the people living inside its economy like Sarah choose to meet this moment with the same resourcefulness that built American economic strength in the first place.